If you're thinking about doing Roth conversions anytime soon, stop what you're doing and watch this video because Congress just passed the One Big Beautiful Bill and it might have massive implications for your retirement tax strategy, especially around Roth conversions. Because if you're not careful and you're not paying attention, you could end up paying more in taxes than you expected. So today we're going to break down this bill and the tax implications, especially when it comes to Roth conversions. But first, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping a million people retire without worry. Today, we have a special guest. We are going to hear from Noah Hankin. Noah is on our team here at Foundry. Noah is a CPA and a certified financial planner, and he's been knee deep, maybe I should say neck deep in this bill. He has spent an incredible amount of time trying to wrap his head around the new bill and its implications for retirement tax planning. This week in a meeting, Noah told me it's going to be impossible to plan for Roth conversions without using some sort of sophisticated tax software to properly account for the impact on your effective tax rate. So in today's video, Noah's going to walk you through some of the key provisions and the new law and what it means for you and for Roth conversions, especially if you're over the age of 65 and you're doing any type of strategic tax planning. This episode is worth your time, and please leave your questions in the comments and we will try to get to a few of them. Now I will turn it over to Noah.
Hello, my name is Noah. I'm a CPA and a certified financial planner. I'm back again. I'm not Kevin. And today we have the exciting topic of Roth conversion planning and the One Big Beautiful Bill Act. So let's dive right in. And before we start, I just want to give the disclaimer that this is not tax, financial investment advice. It's not a comprehensive list and is not, um, everything to do with Roth conversion planning. With this act, there's a lot here. It's just for informational purposes, and just know that provisions are still subject to change because IRS interpretation is not final yet. So just make sure you consult with a qualified tax professional before making any, financial tax decisions based off of this. Um, so the One Big Beautiful Bill Act was passed on July 4th, and there's a lot of pieces of it, right? I'm going to share my other screen right here. And here it is. Here's the Congress page, right? It's a lot of stuff. And it's not just one thing. It's basically like, it's not one big thing. It's one huge list of a lot of small things, and it just keeps going. And there's a lot of provisions that are going to apply to retirement planning. And I wanted to just kind of create a comprehensive list or semi-comprehensive of all the key aspects for just retirement planning, specifically for Roth conversions. So let's go look at, the key areas here. And the big one is tax bracket changes. And I'm going to go into all of these topics separately, and then standard deduction amounts. This huge one for retirees and people older than 65 is the enhanced senior deduction, the SALT cap increase, the no tax on tips, no tax on overtime pay, itemized charitable deductions, itemized deduction limitations, AMT, the alternative minimum tax. We're going to get into that. And then just generally looking at all the phase outs and tax cliffs. Because when we think about Roth conversion planning, the main thing is tax rates today versus future tax rates. And if we expect that tax rates today are more favorable now than they will be in the future, then we do conversions. We just have to be aware of the effective rate, the incremental rate of doing additional dollars, creating more ordinary income, and how they apply to the phase out limits and how that impacts that additional dollar you're converting. Because if it, there's some parts where this might be close to 10% effective rate. And if you're not aware of it, it could have, bad effects on doing the Roth conversions may not be as favorable. So that's really what we're looking at today. First area here is tax bracket changes. Basically the extension of the brackets from the Tax Cuts and Jobs Act, but it's also the widening of the 10 and 12% bracket, right? In 2026, depending on the inflation rates that they use for next year's updates, the 12% bracket could be over $100,000, which gives a lot of opportunity. Here I did a 2.5% inflation rate on the tax code, and you can see that one here goes over 100,000. We have 101,850 at the 12% bracket. And I have all the code sections on all these slides. So if you want to dive into the code, please be my guest and feel free to read the code. It's great. I spent all day yesterday just preparing this. So it's just a great use of your time to read tax code. And that's what we do here. Also, with the regards to that is now, because of this, I don't think Congress thought about it very well. In fact, I know they didn't. is that the difference between ordinary income brackets with capital gains thresholds. Before, it was a very small amount difference between the two. Now it's over $1,000 for single files, right? So there's a scenario where your ordinary income threshold is 12%, but you could be pushed into the 15% capital gain bracket. Um, which is 3% difference, and that's just something you need to be aware of when creating more ordinary income to push yourself into that bracket. Other part that's you know now permanent or semi-permanent. Nothing really in tax law is permanent, but the standard deductions are going to remain at the Tax Cuts and Jobs Act level plus a bonus. So it was going to be 15,000 in 2025. Now it's 15,750. So we all get an extra 750. Married filing jointly get twice that. So exciting there. Here's a big one for seniors, right? The age 65 enhanced senior deduction. It goes only for tax years 2025 to 2028, though. So over the next few years, anyone over 65 can get this additional additional deduction of 6,000 per person. It was kind of marketed as like a no tax on Social Security. It's not that. It's a additional deduction. So there's a big difference between those two. It will be taxed, and there is a phase out range you have to be aware of. And this is where we start getting tricky with Roth conversion, because if you're over 65 and we do conversions, now the effective rate of that conversion is a lot higher than just converting the 22% bracket or wherever this ends up being, because you're losing that $6,000 deduction. So we can look at this on. I have some really exciting software that can model out the ranges of, and it's called Range Calculator. But basically, we can see what amount of income changes that effective rate of your taxes. So I'm going to go share that slide, and I've created all these scenarios, and we can dive into each scenario specifically. So we can see here, this blue is your ordinary income rate. I can turn that on and off. And then here, this green one is the enhanced senior deduction phase out. So we can see here, if we look at the screen closely, 2.6% effective rate from losing that phase out there. And then it goes to 2.9 at the 24% level up here. So you just need to be aware that Roth conversions are not just going to cost you 22, they're actually going to cost you 24.6 at certain levels above, right around 151,000. This is married filing jointly as well, just to be aware of that. All of these examples are going to be. If popular demand wants single tax rates for that, I'm happy to do another video with just single. Let's go back to the slides. Because of this senior deduction, the enhanced senior deduction, the actual deduction is higher than that. So we have, and they stack on top of each other, right? So for single filers, it's 23,750. If one of the married filing jointly is over 65, it's 39,100. And then for two over 65, it comes 46,700. That's a lot of deduction. That's a lot. And that creates a lot of opportunity right there to, recognize some whatever kind of income and not have any taxes on 46,700 if you're both over 65 and getting the standard deduction. It also presents an opportunity for long-term capital gain harvesting. So we can see here that at the $96,700 level, we're still in the 0% marginal bracket on long-term capital gains. So I created a scenario where we look at, total income of 143,400 in long-term capital gains. That you can see that right here, that this long-term capital gains number, 143,400. That's a lot of money to be taking those capital gains, right? Gain harvesting and pay zero taxes. That's a huge opportunity. That makes me think, right? Does it make sense still to maybe start contributing to, rather than doing a 401k or a traditional IRA, maybe we put something in a taxable account, because there's a lot that we can harvest from there without paying any taxes eventually. You still want to get your, match, whatever, depends on your specific situation. Now I'm thinking taxable accounts are more favorable than they were with these, for ages 65 and up and, all that put together. We have the SALT cap increase. This is 2025 and it sunsets in 2029. Basically, everyone gets $40,000 of deduction. Married filing separately gets $20,000. Doesn't matter if you're filing joint or filing single. Phase out ranges are the same, and the deduction amount is the same. So it's kind of a merit penalty on married couples right there, because you're not getting any additional benefit for each of you. It's the same amount for single and married. Not sure why they did that, but that's how it is. I'm not sure why Congress does anything. I'll just say Congress doesn't even know why they do things. There's a 1% inflation adjustment on that, not like tied to the CPI or anything. It's just 1%. And once you get over this phase out range, it goes down to 10,000. So You're not going to go to zero. You're just going to go back to the $10,000 level for that self-cap deduction. This creates a 9.6% effective rate in that phase out range. And I'll show you what I mean here. Created another range calc for that one. And you can see this gray box here. That's that top bracket of we're at the 32%. All of a sudden in that 32% bracket, it goes up 9.6%. At the 41.6% effective rate on Roth conversions in this area, or any ordinary income additional there, which is quite a bit of that's a pretty high tax rate. All that to say there. Goes back down quickly because you get back to the $10,000 level. So it's a small little band there where Roth conversions are very expensive. And back to the slide here. I have that, graphic there in the slide deck. I'll try to share the slide deck with everyone as well. We'll talk to putting that in the comment section or wherever in the notes. Another thing to be aware of is there's no tax on tips in this one big beautiful bill, but it's qualified tips, and it's not actually no tax on tips. It's a deduction on qualified tipped income. It's a $25,000 deduction, not eligible for married filing separately, and there's 3 separate phase out ranges of there, which goes 2.4, 3.2, 3.5. In this 300,000 to 550,000. It's a big range, and it's based off your modified adjusted gross income, the AGI plus foreign earned income exclusion plus foreign housing exclusion. Show you what I mean here. You can see that these numbers here. Let's go to actual range calc and look at that. So this is the no tips one. We can see you're in the 24% tax bracket here on where this starts to get phased out, and there's a 2.4 increase there. Goes to 3.2 on this part of the 32% bracket, and then it goes up even higher to 3.5% there once you hit the 35% bracket. And you can see all that. Going back to the slides, same exact thing for overtime income. And remember, this is not actually the full overtime income. So if you make $100,000 or $100 an hour and your overtime rate is 150, it's only the difference between the 150 and the 100 that is the qualified overtime compensation. It's not the full 150. Want to make that very clear. It's a $25,000 deduction for married filing jointly, $12,500 for everyone else. And you can see the phase out ranges here. It's the same principle as the tip income. Let's go look at that one, where it's these little bands as well. Let's make the range end higher so we can see it all and update that chart. And you can see it's a 2.4, 3.2, and 3.5, making Roth conversions at the 35% bracket actually 38.5, and in kind of the same principle for all the underlying brackets there if you have overtime income. There's also now an itemized charitable deduction floor going into effect in 2026. Not a huge floor, it's 0.5%. So if you're making $100,000, the minimum, the floor is $500, so you're losing $500 of deductible charitable deductions there. Still has the 60% AGI limitation. That's intact. It's very similar to the medical deduction floor on Schedule A of the 1040. So that's how I compare it. It's probably the least impactful part of this legislation here for planning purposes, but still good to keep in mind. If you're, a high income earner and you want to give quite a bit of money to charity, it probably makes sense to start doing a donor advised fund in 2025 before this gets into effect, to kind of preemptively get in front of that 0.5% AGI floor. That's what I would do if I was going to give to charity anyway. But remember, giving to charity only makes sense if you're already going to give to charity, right? You're not going to make more money by giving to charity than you would if you just kept the money and paid the taxes on that. And then there's an itemized deduction limitation. This is also 2026 and beyond, and it only impacts people in the 37% bracket. Basically, if you're in the 37% bracket and you're doing a itemized deduction, you're getting a benefit at the 37% level where everyone else is getting it at lower levels. So they're reducing your benefit by, get this, 2/37 of the lesser of total itemized deductions or all taxable income above the 35% bracket. It sounds more complicated than it actually is. They're basically keeping the deduction limit at the 35% level is the goal of this one, the intention behind it. AMT, this one could be huge for a lot of people who have AMT. For most people, not going to be an impact, but the phase out AMT will drop back down to 2018 levels, pre-2018 levels, I should say. 500,000 for single, 1 million for married filing jointly. thresholds index for inflation, and the phase out rate doubles from 25 to 50%. All this is to say this could be a very high impact on your effective tax rate if you're doing conversions and triggering more of this AMT tax. Uh, oh, it's around like 9% level there. So if you're subject to that, otherwise, don't worry about this one. If you're not paying AMT, you should know if you are. Um, Visualizing these phase outs, uh, there's just so many things going on here. And if you're not aware of all the specific ones that apply to you, you could make some very expensive mistakes, doing Roth conversions by making more income. Um, this is really just about Roth conversion planning because that triggers ordinary income tax and pushes you into the higher brackets, which could trigger more phase outs and more brackets than you even thought of. So that's mostly what I want to get at with this presentation. I know it's very quick, very high level. Um, there's a lot more information. I'm going to link in the slide deck below or in a couple pages. Here's a visualization. We kind of put everything together. We have net investment income tax. We have overtime deduction phase out, no tax on tips, enhanced senior deduction, SALT deduction, medical expenses, capital gains and qualified, and then taxes on ordinary income is the normal one. All this to say there's a lot that can happen. And if you're not using software that can do this for you or you're not working with a professional, like there's no way I can keep track of everything in my head, what's going to happen here, where it's just too much. That's why I'm so thankful we have tools like Holistic Plan at Foundry, that we can actually do tax planning the right way. And just being aware of it is half the battle. Not to mention, I didn't even mention IRMA, but IRMA, these dotted lines here, these are all the different IRMA tiers that we want to be aware of. So doing Roth conversion planning, you have to think of all this and IRMA just like you would normally. So some high level planning opportunities based off our discussion. Just be mindful how the Roth conversions interact. I think I said it enough with phase outs. Evaluate that standard versus itemized deduction each year. And one opportunity if your state allows it, consider bunching property taxes to maximize that SALT deduction in, if you can do 2 years in 1 year, like and I think Texas allows that, do that. If it makes sense for you. I'm not, all general financial, not financial advice, right? Bunching charitable donations in 2025 because of that floor limit. If you're a high income or poor earner, that could be a huge strategy for you because you're getting that extra deduction. And then really like does the taxability, the tax allocation of each account now maybe because of this huge tax gain harvesting potential, like almost $145,000 of income, not quite there. Maybe that's more impactful for you than it is to contribute to a 401k or a traditional IRA, even a Roth. You just want to make sure you're aware of your specific situation because it's personal finance. It's not general. It's very specific to what you want to achieve in your goals as well. My final thoughts are just use the planning software, work with tax professionals who are up to date on the One Big Beautiful Bill. At my general thought is tax planning and tax preparation might get more expensive this year because this bill's huge. There's so much interpretation to be had still by the IRS. We're still waiting on some things to come through, like how is it actually going to play out? And be, cautious of what you see online, including this video, right? Because things can be wrong. People can get ahead of things and they're not quite right. And you just don't want to make mistakes here. Could be very expensive. Some of the resources I used, Roger Pine with Holistic Plan. He's got some great videos that go into more detail on each of these topics I went into. Ben Henry Moreland from kitses.com. He's a CFP as well and an EA. He breaks down the One Big Beautiful Bill Act in the impact on new laws on tax planning. I use that article quite a bit. I use some this slide here is from him. So thank you, Ben. Promise to give you credit there. Jeffrey Levine. I actually taken a course with him, the tax planning certified professional. He did a call with Roger Pine from Holistic Plan, and that was very useful for me for putting this all together. And Michael Kitces in general, like his information is great. I would use those if you want to dive into detail on anything talked about more. And then if you want to, work with a financial planner, professional tax planners that do this day in, day out, please reach out to us at Foundry. So appreciate you guys watching. I know the One Big Beautiful Bill Act is what everyone's thinking about right now. And it's such a fun topic to spend your weekend reading this bill. So thanks for staying to the end and back to Kevin.
Hey, thanks for watching. If you want more information on planning for taxes in retirement, I put together a whole playlist and you can watch it now.